the 10th International Relations. What are the risks and opportunities of economy? Today, we will discuss about the impact of COVID-19 on property and equity investments in Greater China. This event is organized by the University of Chicago Booth Alumni Club in Hong Kong. I am Bessie Chen, committee member of the club. Also, another moderator is Daniel Wu, the co-president of Hong Kong Booth Alumni Club. Daniel.
Thank you, Betsy. My name is Daniel Wu. Together with Brian Choi, we are the co-presidents of the club. Today, Betsy and I will be the moderators. The club has started the initiatives of Distinguished Alumni Sharing Series since 2018, but typically in a roundtable dinner format with around 15 to 20 people. But today is our first time to do the event online, and we have over 160 alumni and guests from all over the world registered and will join us soon. Before we start, we would like to just announce some house rules. First, everyone is on mute mode now. Second, after all speakers complete their sharing, we will have a Q&A session. If you want to ask a question, please raise your hand and we will let you know. You can click on mute, then ask a question directly.
Thank you, Daniel. Thank you, Daniel. Before we start the sharing, first, let's welcome Mark Benico, Executive Director, University of Chicago Francis and Rose Yuan Campus, Hong Kong, to give the opening speech.
Thank you, Betsy, and thank you, Daniel. And good afternoon from the University of Chicago, the UN campus here in Hong Kong. First off, I'd like to thank Brian and Daniel for inviting me to this event and welcome Samuel Chu from the MBA class of '87 and Renee Hung, who with her father, Raymond Hung, MBA 73, have been great supporters of the UN campus here in Hong Kong. We'd especially like to thank alumni and friends joining from across Asia and the world. We recognize the topic of Greater China investments is certainly relevant to many analysts and professionals across the region. So we're really producing this content for you, and we're very glad that you joined. I'm thrilled as a Booth alum and as the executive director of the UN campus to be kicking off this Hong Kong Booth Alumni program this afternoon. It's the first of a series. Now that large physical gatherings are not immediately possible on the UN campus, the Alumni Club has decided to deliver the first in a series of webinars online. But this is a continuation of meetings that were happening before the coronavirus. 16 people or so would get together and have C-suite type meetings and events that the Alumni Club arranged. For those of you who aren't aware, the UN campus team in Hong Kong has used the current pandemic situation as an opportunity to move from small in-person events on campus to much larger global events spanning many time zones. You can find these events and many other UChicago and Chicago Booth events around the Asia Pacific region listed on our website at www.uchicago.hk and on the UChicago UN campus Facebook page. The alumni clubs around the region are also doing the same so that these online series can reach an even broader audience globally. And in addition to promoting to global alumni and over 54,000 Booth alumni via the update, these events will be promoted broadly outside of the Booth community and on social media. So I like to say that this is really a period of crisis, but also there are many silver linings that can be found. To document the crisis, one project that I wanted to make everybody aware of on this call is a project that the UN campus is leading as a pilot project called Crowdsourcing COVID-19 History. We're leading that on behalf of the university at the moment, and we just launched it this week. Your digital stories and images will be archived for future students and faculty and the broader community to research 10, 20, and even 100 years from now. You can find out more about this historic project driven by the alumni in Asia first, on the Alumni and Friends page at the uchicago.hk website. So before we get started, I'd like to share some data and a few observations regarding the current situation in the US. I know this is an Asia meeting and speaking specifically about investments in Asia, but like the 2008-2009 financial crisis, I think the US there will be global consequences overall. So first, it's not clear to me that the average American is aware of how dire the virus situation is. And maybe we aren't so much here in Hong Kong either. So let me remind you of the numbers. Right now, we're approaching about 10 million cases of the virus globally and nearly 500,000 deaths. The US ranks first with over 25% of the cases and about 25% of the deaths, while China ranks 22nd with 83,000 cases and over 4,500 deaths. Japan ranks 52nd, and Hong Kong, I like to look at this number since I live here and I like to see how safe I really feel I am. But Hong Kong ranks 119th with only 1,197 cases and 7 deaths, making it what I feel is one of the safer places on the planet. Brazil, Russia, India, and the UK hold the other top 5 spots with the United States, and their numbers are growing rapidly. The unemployment rate in the US, for those of you who may not be aware, it did drop from 14.7% to 13.3% from April to May. However, there were 1.5 million people who filed for unemployment just last week alone. So that number is likely to rise. In the US, Americans are skipping personal and corporate rent and mortgage payments. The data that I have says that 30% of Americans miss their June house payments. Companies are allowing people to work from home, some of them indefinitely, and especially where I come from in Silicon Valley, a lot of the tech companies are saying work from home and we may not have you come back to the office in the future. As a result, corporations are looking for ways to reduce costs by cutting their rent expenditures. Many are saying that this pandemic may have consequences for the US market 10 and even 20 years from now. And like the 2008-2009 financial crisis, I'm expecting this pandemic to create a shock to the US system like 10 years ago that left many people homeless. And I'm afraid that the pandemic will actually add to the US homelessness crisis that already exists. Some are calling what's about to come apocalyptic. And so I think that we've been lulled into thinking that everything is going to be okay, but there are going to be waves and there are going to be ripples to this pandemic that I think haven't been seen in the economies, certainly in the US and around the world yet, other than blips in the stock market that we've seen. So as a regular follower of the stock and housing markets in the US, it's clear to me that the impact of the pandemic on these markets has been modest so far. But another thing to keep in mind, and the UN campus is going to feature a series on this later this summer, we have an important presidential election approaching in November with tremendous consequences for the world. And let's not forget, climate change continues to be a problem that devastates the world with record temperatures, rising seas, severe weather events, and where I'm from in California, record wildfires. So where markets will end in the next 6 to 12 months and beyond is for a lot of our smart economists at Booth and the University of Chicago to determine, not for me to determine. But as an investor, I always try to look for a silver lining, and I plan to keep my powder dry during this downturn. Opportunities can be had if you don't enter the market too soon. And I still think it's too soon. I don't think we've seen the worst of it yet. Other asset classes do create new opportunities. And in Silicon Valley, where I spent 20 years as an entrepreneur, we like to say that down markets are great times to start new businesses. So we should see a lot of new business activity that emerges from this crisis. And it's a tremendous time to renegotiate agreements with vendors and landlords, let's not forget. So while the coming few months look quite bleak, in my opinion, I'm confident that many of you on this call will find incredible investment opportunities. Those are my thoughts on the current situation, but we have experts here to share their insights, and we need to get to them. So I hope you'll all continue to look for silver linings in the current environment, and please stay safe. Thank you.
Thank you, Mark. Stay safe. Next, to introduce our first speaker, who's alumnus Samuel Chu. Mr. Chu is a co-founder, managing partner, and the CIO of Phoenix Property Investors. Phoenix Property Investors is a fund-managed private equity real estate investment group, managed over $11.8 billion gross real estate assets in the past 17 years. Currently manage $7.7 billion assets. Mr. Chu has more than 30 years of real estate investments and corporate advisory experience in Asia, Europe, and the US. Mr. Chu has been investing in real estate since 1989, with a track record around $9 billion invested assets around the world. Welcome, Mr. Chu.
Thank you. Can you hear me?
Yeah,
Hi.
we hear you.
Yeah, thank you for joining on a Saturday afternoon. Yeah, I think everybody's, probably spent some family times and want to learn about the Asian real estate. I think today we are talking more about Greater China and in fact, about the impact of Greater China of the COVID-19, how does it affect the market and what kind of opportunities you see in the Greater China area. Just for information, Phoenix has 7 offices around Asia. Greater China is one of our markets, but our biggest market actually is outside Greater China is Japan, Korea, Australia, and Southeast Asia. So, today we're going to talk about Greater China. Should we have any time, we want to cover the rest of the area during the Q&A sessions. So let's start. The market right now is very fluid. Across Asia Pacific, lockdown is being eased right now, and it's encouraging sign of returning to normalities. Nonetheless, this pandemic has huge social impact. My focus today is to answer a question that I ask most often by LPs. Is understanding the real estate market implication of the pandemic, we need to first understand the economic outlook might change. The number one question is whether Asia growth model will change given the return of supply chain back to the US and Europe. So we're in a period of deglobalizations. However, the deglobalization began with a global financial crisis, and yet Asia has not seen any notable impact at this moment. Domestic growth drivers have become more important over time. This is the reason why the Asia Pacific economy is 40% larger than the US now, having been on par only a decade ago. The virus will be gone eventually and contained eventually, at which point local growth driver will reassert themselves. Asia has many large domestic consumption markets, as well as strong leadership in technology infrastructures. And these are important of our key investment markets of Greater China, Japan, Australia, and Korea. Also relevant to the real estate market are the prospect of urbanizations. Urbanizations in major cities like Hong Kong, Shanghai, Tokyo, Sydney has been crucial in generating robust real estate market performances in the past. Despite current fear over urban environment due to COVID-19, we expect to see normalizations with respect to city-based living and working. This reflects the fact that cities provide higher quality amenities like healthcare, education, transportation, as well as good paying jobs. Also, cities have historically persevered through past pandemics, such as SARS and MERS in Asia, and past pandemics such as 1918 Spanish flu. The decade after the Spanish flu, which killed 50 million or more people globally, major cities around the world experienced rapid population growth. If you look at this chart right here, you can see New York population grew by 27% from 1920 to 1930. Chicago, 34%, Tokyo by 45%. And during the current pandemic, Asia urban centers have coped remarkably well. The number of deaths are very, very low, which further support the return of normal city-based activities. For example, here in Hong Kong, our office is totally back working, and all the staffs are working back in the office now. A lot of people is asking about whether there's a massive move to home working, while this have a big negative impact on office real estate that Mark had mentioned earlier. We believe home working cannot be replaced the need of nurture and growth personal network. And these networks develop best in urban locations. For example, IBM, for many decades, actively pushed for home working and reached 40% of the global workforce by 2009. Then in 2017, IBM completely changed its mind. Despite being a tech company, well-equipped to make it work, they still fail. The main issue is the long-term collaboration ability to innovate. IBM was falling behind its office space competitors. We do, however, expect home working to increase over time, perhaps to a few days a week on average. So desk space is still required. What may that mean to the office market? Surveys in Australia indicate that only 10% of the workforce will end up working from home. But other factors continue to drive the office demand, such as rising populations, rising office using industries, for example, technology, financials, and professional services. Due to the depth of economic downturn, we expect the real estate market to show significant weakness in the near future. It is not clear how long this downturn might last. Looking at the previous Asian real estate market cycles, office rent can fall anywhere between 20 to 40% on the average downturn length for 2 years. Past down cycle has been either very deep or long, but it's typically driven by high inflation and high interest rates. For example, you look at the chart, Asian financial crisis in the late 1990s. However, the current situation is a little bit different, where interest rates are very, very low and policy support are significant. The downturn duration has been short-lived. For example, the dot-com bust and the GFC. This downturn appears to be quite similar to the last two, where there's a lot of substantial government and central bank support policies. Also, this is not a financial crisis. The bank is still lending, but cautiously. This may help to limit the length of a downturn, but ultimately the path to real estate market likely to depending on the vaccine or cure or being available for COVID-19. The huge governmental and monetary support so far is similar and bigger than what we've seen after the Lehman fell, and come much faster, within weeks rather than taking months. In Japan, announced measures alone are over $2 trillion and more than 40% of GDP. Similar support is evident elsewhere in the region, such as Korea, Australia, and China. This cannot prevent the decline in activities, but can help to soften the blow and contain bankruptcies and unemployment. These policies have resulted in market drop in interest rate in Asia Pacific. We believe in long-term prospects make real estate look attractive. Real estate yield already look attractive compared to government and corporate bonds. And most of the sovereign funds and institutional investors around the world are looking for a yield at this moment. We are mindful of the fact that short-term is at risk due to economic disruption from the virus. For example, the retailers being unable to open and trade. We believe that once the situation stabilizes, our view in the market in selective area may look attractive, should interest rates stay in a very low level. Turning to China, the trade war between the US and China escalating tensions due to COVID-19 are not a very positive sign. At the same time, we are seeing opportunity in the region, given the scale of economic growth that's likely to take place in the next decade. For China, two sectors looks quite interesting, which is logistics and data center development. For logistics, there's a huge potential growth demand of modern warehouses by two key factors. E-commerce already accounts for 20% of retail sales and is still growing rapidly as the middle class population expands. China's supply chains are modernizing and focus on cost reductions, which increase the demand for high quality logistic buildings. At the same time, the size of modern logistic market in China is still very small compared to the US. We also see this asset class, in light of rising liquidity, interest rate from a lot of rising interest from institutional investors. However, our focus on logistics is basically focused on first-tier cities, which are likely to be supply constrained over time. Other cities like second, third-tier cities, the lack of supply constraint are unlikely, and so the investment may not be that rewarding. As for office sectors in China, in the first-tier city, we think there's going to be a short-term hiccup, but medium, long-term is still positive. Some of you may have read from the article South China Morning Post today about that Phoenix had encountered a headwind for one of our projects in the Shanghai office. Despite this, we are continuously making investment in the sectors as stated, and we are positive in the medium, long-term prospect of the office sectors in the first-tier city in China. Look at data centers. The growth in cloud, remote data storage demand is huge, generating need of more data centers. This demand is like of Tencent or Alibaba. With the advent of 5G and demand of data center, we rise even further, fueled by gaming, social media, and video demands. For mission critical support, data center need to be located near customers to ensure speed and stability of service. This asset class is mature, but is likely to be institutionalized. Again, our focus is in the first-tier cities, which face demand-supply imbalance due to regulatory constraints. For Hong Kong, the Hong Kong investment market has been weak since 2019 due to reduction of mainland buyers who face difficulty of getting capital out of China. Also, escalating US-China trade war hurt sentiment and investment demands. With the civil protests and the new national security laws, investors are being very cautious. So far, the asset owners in Hong Kong has not tested the market and sell at large discounts. The lack of leverage and low interest rate mean there's a very little distress at this moment. For offices, the fundamental appear to be good despite short-term pressures. IPO activities in Hong Kong is picking up again strongly as mainland companies start to avoid US capital markets. Hong Kong is a strong unique position with strong connectivities to the mainland, yet free capital mobility and common law traditions. As such, the city continues to play a vital role in China offshore financial centers. Thus, we can see opportunities in two sectors at this moment. Number one is industrial sectors. Due to the revitalization policy, which allowed conversion of alternative uses, such as self-storages, potentially even more sophisticated storages like cold storage or off storage. Second is site assembly strategies. This strategy works very well in the soft market, where mom and pop investors may be more motivated to sell on weaker sentiments. We've been working on this strategy for the past 12 and 15 years. It's been very successful for us. Some of you might know some of the buildings that we assembled and built, for example, Tower 535 is assembled after Lehman crisis. In conclusion, there are a few key takeaways. This crisis is not a financial crisis. Once the virus is brought under control, we will see a rebound in real estate prices underpinned by very low interest rates. As value become evidence, it makes sense to actively deploy capital rather than wait for a turning point. It's hard to pick the bottom. So we are investing when we see value emerges. In terms of strategy for the next 12 to 18 months in Greater China, as mentioned before, we like logistics, data centers, with a strong structural story. But we are very oversupply in some markets, the second, third tier cities. We believe that the value add opportunistic strategy are more likely to be more rewarding than the core strategies. Besides the above, we've been extremely busy on the debt space. Our real estate debt fund platform have been doing a lot of deals recently in Greater China, Australia, as local banks, and being very, very cautious at this time. I will conclude my presentations, and we would have a Q&A after the Renee presentations. Thank you.
Okay, thanks, Sam, for your valuable sharing. Next, to introduce our second speaker, Renee Hung. Ms. Renee Hung is the Deputy Chief Investment Officer and Executive Director of Value Partners Group. Value Partners is one of Asia's largest independent asset management firms with assets of around $11.3 billion. Ms. Hong has worked at Value Partners over 20 years. This is her first job. She has extensive experience in the financial industry with a tremendous record. Ms. Hong is also very supportive to our U Chicago Hong Kong campus. Welcome, Ms. Hong.
Thank you, Betsy, for the introduction. Let me upload share the screen for the presentation. And bear with me a second. So do you hear me? So good
Yes, I can hear you clearly.
Yes.
Great, thank you. So good afternoon, ladies and gentlemen. So in today's presentation, I would like to talk about how we see the market and where do we see opportunities and risks. So allow me to go through a quick review year to date for the stock market index. In this slide, I have highlighted to you the stock market year to date saw a bottom at the end of March, 23rd of March 2020. And then from that point onwards, Dow Jones actually, and also many other stock markets staged an amazing recovery. Dow Jones index increased about almost 40% since the lowest point. And European stock market also rebounded like 30%. On the other hand, MSCI Golden Dragon, which includes the listed company in Hong Kong, China, and Taiwan, and also CSI 300, which are the listed companies in the onshore Shanghai and Shenzhen A-share market, they respectively increased about 20%, 25% and 16% from the lowest point of the market. So the strong market recovery is actually kind of unjustified in our view. And we would attribute this to because of the various aggressive stimulus program globally. If we look at the year-to-date stock market performances, actually, we see quite a different view from these few months. As of year-to-date, a lot of the global indices are still suffering a decline. For example, Dow Jones is still down 10%. FTSE is still down 20%. And there are many other stock markets were down more than 20 or even 30% year to date. At the same time, China-related market, namely the MSCI Golden Dragon and CSI 300, relatively perform fairly stable. Year to date, the performance is around 0%. And we believe there are solid reasons as to why this happened, and this will continue. And allow me to elaborate in the next few slides. So in this slide, I have shown to you some basic economic data. On the left-hand side, you can see the GDP growth rates forecasted by Goldman Sachs. I highlighted the actual Q1 data and also the estimated Q2 data. More importantly, I want to draw your attention to the full year data as at 30th of May. These are the numbers after rounds of downgrades. And one point worthwhile to mention is that China is the only country here can still deliver a positive GDP growth number for this year. So on the right-hand side, I have also listed out various countries or regions' EPS growth forecasts. At the beginning of the year, which is like 10th of January, of course, a lot of the investors or consensus would expect that earnings would be positive for this year. But after the COVID-19 outbreak and rounds of downgrades, earnings downgrades, we have seen that the picture changed a lot. But it's also worthwhile to highlight China-related markets here. As you can see, the EPS changes for 2020 still outperforms a lot of the regional or global countries. And being able to keep on track these kind of growth rates for China is very important for our investment case. So far, we have been tracking industry data on a weekly basis after the COVID-19 outbreak. And I have highlighted here a few key industries. For example, mobile phone sales, passenger car sales, or even sportswear company sales through. So we have recognized and we have seen actually the recovery in China is definitely on track. Maybe it's also due to the fact that it's first in, first out. We have seen a gradual recovery in all these on the ground data since April and May. And we believe that behind it is very important to mention, China is supported by this strong domestic market, over 400 million consumers, and a strong capital control country, which a lot of people criticize. But actually in this round of challenge, it helps them to allow more buffer to give them time to recuperate internally. Well, I mentioned previously that the stock market rebounded very sharply since the end of March. And one reason, the key reason I would say, is because of the very aggressive stimulus program. So here I have listed out a few countries in terms of the asset purchase program. As you can see, USA, and also maybe you have also heard that Australia also announced an unlimited quantitative easing program to pacify the investors. But one would question how much more room they have to carry out these kind of exercises. And if we look at the rate policies, also here again, if you look at the lower half of this slide, US has already decreased interest rates by 1.5% since 2020. Same for UK, Australia, and a few regional countries. They have all aggressive policy rate cuts. And if you look at the upper half of this slide, you know, how much, once again, I would ask how much more room these countries have in future in case they need to reduce more rates to stimulate the economy. On the other hand, China has a lot of room for rate cuts. Year to date, China has so far cut about 0.3% in terms of the policy rate. But depending on which reference rate that you use in China, but at least like you can see the China MLF or China LPR rates, they are both at about 3% or more levels. So we do see that in case needed, China is the country which has the most room for further rate cuts. So instead of asset purchase programs or maybe aggressive interest rate cuts, again, due to the first in, first out reason, China was able to launch many stimulus measures targeting different regions or industries. This is only a very small subset of it. And it's no magic, but it's very, it's targeted and also very trying to help what's happening on the ground economy instead of stimulating another bubble in the economy. So this slide is just a brief summary of the valuations in a few regions globally and also regionally. And I also have included some of the earnings growth or earnings decline, to be exact, to put things in perspective. So as a professional investors, I think it's easy to draw the conclusion that USA is now fairly overvalued compared to many other countries, alongside with the world developed markets. On the other hand, China or China A share market or Hong Kong market are relatively inexpensive in terms of valuations. Whereas at the same time, the earnings decline is also less aggressive. So I think it's maybe I would argue that China or China-related markets have already factored in more bad news in the price, and potentially, hopefully, that we can see more promising outcome. We also try to study, the companies in Greater China versus USA, Japan, or developed Europe. And we note that maybe it's because of the culture or many other reasons, the balance sheet of the companies in Greater China are much more healthier. For example, like the cash to total asset ratios for Greater China is 16.2% versus these other major economies around 10%. Another important ratio to check the balance sheet is the net gearing ratio. As you can see, on average, the Greater China companies on average has a net gearing ratio of 25%. This is very healthy in many standards compared to maybe USA, Europe, or Japan at a much higher level. So having said that, I'm not saying that is a very sure, a solid. There's no worry or no challenge in China. In China, I think after the COVID-19, one thing we worry most is the unemployment rate, because it links to a lot of systematic issues in China. So every year in China, the government has to create about 10 to 15 million jobs per annum. But for 2020, due to the weak demand for export goods, we may have some challenge here. Maybe at most we can see a slight increase in new jobs creation or even negative at the end of the year. We also worry that, and we can never be sure if there is a second wave of the COVID-19. In our view, Sino-American relationship is actually definitely the #1 and most important challenge for China. Of course, we believe that the two biggest economies globally should cooperate and they complement each other. But so far now, we are dealing with a lot of tensions and we have to endure a lot of these news flows at times. So in this kind of context, we are expecting a very low interest rate environment, and the liquidity remains to be abundant, we expect that it's inevitable to see another asset bubble in the making. It's very similar to what we have seen in the global financial crisis since 2008. And the challenge for our this time is that, again, even more money are printed, and this money is going to chase the same assets that we have, we all along have. So we expect that the wealth gap will continue to widen, and it can be very worrisome. Like, for example, the stock market is reaching new highs every other week. Say, for example, in US, or maybe the stock market is holding relatively well in elsewhere as well. But we also are aware that a lot of middle class or working class people are losing their jobs, cannot pay their the mortgage, etc. So somewhere along the line, this is a situation or a system that cannot last. But we don't know when this system will end, or this situation will end. And for our investors like us, or people who have savings, what should we do? You know, because should we hold cash? But we have learned that cash may be also not the best alternative in a liquidity bubble. So for us, we have tried to look at various opportunities, and our conclusion is that for the China story is still very much intact, because China has a very strong government, and the system in China is much stronger than 20 years ago, and the people are still earning good income and good saving rates, and there are many reforms can still be done to serve as a catalyst for the whole China country, that we may see that there may appear to be some sort of hiding place for global investors. But at the same time, we also recommend investors to be mindful of the timing, and also not to put all the eggs in one basket. Another very interesting alternative, which we won't talk too much about here, is gold. But we believe that gold may be a good defense asset in case one day the system breaks down and protects us against this huge liquidity bubble. So I think going the next few slides, I will talk about some of the structural trends that we identify in the Greater China markets. So there are consumption upgrades, technology, e-commerce, education, healthcare, and A-share markets. So this slide actually tries to explain that high-income individuals in China are growing rapidly per annum. According to the data point, we learned that since 2015, every year these so-called high-income individuals in China are growing 20% per annum, and we expect this to continue at least till 2025. What does this mean? This means that every year, China is adding 11 million of the population categorized as the high-income individual. These high-income individuals, as they upgrade in terms of the income, have more demands in products or services. And we also realize that compared to maybe the last generation of high-income individuals, when they first made money, the last generation maybe opt for buying apartments, cars, TVs, refrigerators. But the new generation of high-income individuals would prefer to buy things, or maybe invest in things that can improve the quality of life, or maybe for their enjoyment, such as like traveling, or beauty services, or even like get some pets and etc. And we also come across many different surveys to support our view that according to even this McKinsey survey, that consumers in China are very willing to trade up in this kind of a consumption upgrade cycle. For example, like cosmetics or sportswear, in the past, maybe they are very interested to buy, are very excited to buy a pair of sports shoes. Now they are looking for brands, maybe Anta, maybe Li-Ning, maybe in first tier city, they really want to opt for like Under Armour, Nike. So there's different segment of consumption upgrade that we see within China. In our study, when we do our research in the market, we also come across a big theme is that the bigger becomes the bigger because they have the scale to invest into R&D for like product innovation or even for sales and distribution in terms of the scale. Product innovation is very interesting story for these consumption upgrade cycle because as you can see on the left-hand side of this slide, like dairy or beers or instant noodles, whenever the company launch a premium product, the selling price is usually 2 times or 3 times of the average selling price of their existing products. So if they have a hit product in this kind of premium segment and is totally aligned with the consumption upgrade demand of the consumers, they will have they will make a better profit margin from these new products. And we can see also that these larger companies are gaining market share in China too over the past few years. And we see these Chinese companies that the net margin levels in 2017, 18, 19 is also on a general uptrend because of this product innovation or product premiumization trend. And of course, we don't think that it can go to the similar range achieved by the overseas mature peers in one go, but we do see that they have a lot of room to grow. Technology-wise, it's a very hot topic nowadays, especially with the Huawei incident. But it's also interesting to mention that in 2020, China is the first time surpassed US in terms of R&D expenses. And in 2019, China's patents application has surpassed a lot of these countries listed here. 5G is very important area for China or China-related investments. Of course, we don't know what would the outcome of Huawei be, but we also learned that a lot of companies in the greater China countries, for example, Taiwan or China, they also cater to the competitors of Huawei. So in case Huawei lose out in the 5G era, the other brands such as like Ericsson, etc., or ZTE will gain the share over Huawei and still place the orders to these companies listed in Taiwan or China. And essentially, it's still a very important structural growth story for the whole, for Greater China area. 5G is interesting because the investment for 5G is at least 2 to 3 times more than the 4G era. And then 5G, we talk about a lot of, is there a killer application, etc. or not? But with this recent work from home phenomenon, we learned that we don't really need so much of a killer app for now. We need good connectivity, good performance on the connectivities. And also we see that cloud computing or server demand continues to be very strong due to the increase in work from home demand. All these are driving demand for higher speed materials or maybe components. And again, we are also seeing some structural growth story here. For example, if you look at a 4G smartphone, some of the key chipset in the past maybe is selling, you need to buy at about $10 per piece. But in order to make a new 5G phone, they need to buy a new 5G chipset. And this chipset may cost 35 or 40 US dollars per unit. So it's a jump of easily like 2 to 3 times than the original prices. So a lot of these companies in IC designs or chipset manufacturing or foundry in the region is also very exciting. So, and also we can see that the valuations of the Asia tech companies generally are 20 to 30% lower than global and US. Another next trend that I want to mention is the online services. So e-commerce platform has already been very successful. We have seen very successful players such as Alibaba, Pinduoduo, JD, etc. But we have also noticed that service online platforms are evolving very aggressively. So first of all, in China, we see there's a lot of room to grow for service consumption as a proportion of the consumer spending. As you can see in this slide, China only has 33% of total consumer spending in services versus US or UK more than 50%. Here, we list out the penetration rate of the e-commerce versus the booking services in China. In China, electronic products and apparel have a penetration rate through the e-commerce of close to 50%. Whereas the services such as like booking of beauty services, booking of tutoring classes, or maybe any kind of tour packages is still at a very low level. And it has shown very good growth, and we expect this to continue. Again, the monetization aspect is very interesting for the online service platform. Because the penetration rate is still low, they have not yet fully monetized their activities on the online service platform. If we look at the e-commerce platform now, we see that the monetization rate is 0.82% versus now is only 0.13% for online service platform. This is meaning that the online service is only at like 5 years earlier than the e-commerce platform. And monetization rate meaning that how they can make money or maybe a commission rate concept. Education is also a very prominent and important theme in China. So according to our finding, every year about 16 million people reach the age of 17 and 18. And then we have about 9.5 million people taking the university entrance exam, of which about 7.5 million of them will go on to diploma or bachelor's degree program. So just from here, we can see that there is easily more than 2 million shortage of degree in China. And not to mention the enrollment ratio for university or higher education in China is much lower than like say US or Canada. And it is China's target to increase this ratio to 65% by 2035. Again, this is another very crucial point. We see the tuition fee in China have a lot of room to grow. Currently, on average, this private higher education costs about 2,000 US dollars per year per student. And this is much lower than by all different kind of standard due to legacy reason. And we have seen Chinese government allowing and promoting this private university to increase their tuition fee of 2 to 6% per annum in the past 5 years. And we expect this to continue in the next few years. Healthcare is another important structural theme. This slide is fairly common. It's just saying about like low penetration rate and low spending. To us, it's more important to identify the innovative drug companies in China, which we do see a handful of them now. And also in China, we also learned that we have a cost advantage in the R&D for the pharmaceutical space, surprisingly. Recently, there's a news, Roche is actually has a joint venture with a domestic Chinese company whereby they will outsource some of the R&D. So we do see that this sector has a long way to go. And last but not the least, I would like to talk about a little bit on the A-share market. So MSCI has announced the A-share inclusion a few years ago. This acts as a catalyst to a lot of foreign investors. Foreign investors currently account about 5% of the A-share free float. In fact, we see that in more mature markets such as like Korea, Taiwan, foreign investors, they usually account 30 to 40% of the free float. So we do expect there are more foreign investors very willing to get some investments in the A-share markets. And this is my last slide, is that according to CLSA study, compared to buying into the A-share ETF, one word of advice is that we found that active funds do perform much better than buying the ETF index. Compared to US, it might be a different case. So this is something I would like to share. And here ends my presentation, and thank you for your time.
Thank you very much, Renee. This is a great sharing. And now we are moving to the Q&A session. Once again, if you want to ask a question, please raise your hand and we will let you know, and you can click unmute and ask a question directly. Now in the pipeline, we already see several people are asking questions. First, I would like to invite Ben Charawang to ask a question. Ben, your line now is open. Please speak.
You can ask another question. Maybe he's not around.
Hello, Ben. All right, next question. In the Q&A list, we have one question asking, China has been growth engine for world economy. Do you see it can generate new wealth for investors in coming years? I think this question can be answered by both of the speakers. Maybe Sam, would you like to start first?
Can you repeat the question? The line was broke. Yeah.
China has been the growth engine for world economy. Do you see it can generate newer wealth for investors in coming years?
Well, I do believe that China is going to continue to be the growth engines, for the world. I mean, if you compare the GDP growth, 5-6% is still highest. You compare the U.S., Japan, all the developed countries, it's still, probably the highest, and it is the highest. And there's the technology and infrastructure spendings, R&D spendings is far superior, and as Renee mentioned earlier, which is even higher than the U.S. right now. I think there's going to be a lot of new wealth going to be created, with the tech industries, also, all sorts of industries in China. There was a survey been said early, before that. There was like a 2 billion a year made every week in China, or some figure like that. So if there's a billionaire made in China, there's going to be a lot of people going to be getting richer as well. So I think that that's definitely the case.
Yeah, I totally agree. I totally agree what Sam said. It also really depends on how does the Sino-American situation evolve. You know, China is also trying very hard to develop a domestic economy over the past 10 years, and it has some early wins already. But of course, at the end of the day, we still need US and China to cooperate. But no matter what, we do see a lot of opportunities within China, and this will create a lot of wealth going forward.
Thank you. Next one, I would like to have the question from Charles Zhang. Assuming there is an asset bubble, how does it impact the property market in China and Hong Kong? This question is to Sam.
Okay. The property market is very, very big in terms of which sectors and which industry, which subsectors, right? And China is, China is very big. It depends on which, which cities. There's sub-market. There's some places is oversupply, some places is undersupply. So it's very difficult to answer that. In general, people are looking for yield play at this moment. People are looking for yields, as because the interest rates are, all-time low. And at this moment, as I mentioned earlier, the data centers and logistics offer the better yield because the demands are very, very high, especially in the first-tier cities. But in the short term, there's going to be hiccups in the office sectors because the uncertainty of the trade war with the U.S. and China, tensions. But as for Hong Kong, a lot of people say, hey, the real estate market is in a bubble and so forth. We do not see a bubble in Hong Kong. A bubble means that there's a lot of speculations in the market that say, if previous to 1997, let's talk about the residential market, right? Previous to 1997, a lot of speculated in the markets. There's I own 1 apartment and I speculate 3, hopefully I can sell some of them and flip it. But with all the measures that have been imposed by the government in the past 10 years, a lot of flipping tax, a lot of stamp duties, much lower LTVs, we don't see a bubble. So as the end use is basically driven by end user demands. So for example, the LTV for a residential home is 40%. And if you're a foreigner, to buy an apartment in Hong Kong, you have to pay 30% stamp duties. So that's mean $1 million home, you have to pay $700,000 down. So there's no speculation in the market. And you can see, yesterday the government announced that the new land for sale for residential the next fiscal year is one of the lowest I've ever seen in the past 5 years. So so that's my that's I don't think there's a bubble in the market. China is very big, so it all depends what subsectors and some market. For example, the U.S. There's some market will do much better than others. Like New York is oversupply, whereas Austin is undersupply. So this is a very it's very difficult to answer that kind of questions. Thank you.
Thank you. Another, I guess, is a more property-related question to Sam is that how much distress do you see in China high-yield space? Do you see any sign of increasing defaults, particularly in the real estate sectors?
Okay. There's a lot of funds out there. For example, there's only a lot of big U.S. distress fund been set up to try to buy China NPLs. Right now, we have not seen that many, been happening, not in the large bulk. There's, piecemeals of, but we don't big distress at this moment. And as, as Renee mentioned earlier, the government can always, reduce the interest rates and also can have more stimulus measures. At this moment, we're not seeing a lot of distress, but at the same time, we're doing a lot of debt deals from our side is that we're seeing that the government, some of these listed companies are looking to cannot raise money onshore. They need to raise some high yields offshore. So we have done some some deals which is collateralized by real estate and giving some high yields debt, but it's secure debt.
Thank you. An interesting question comes on the White House election by the year end. What if, when the White House changes hands, do you think it will lead to a positive or negative or neutral impact for the China market? Renee, would you like to address this question?
Sure, I'll try to, because I think this kind of question has different answer when you ask at different times. So as far as we are concerned at this moment, we still believe that if Trump stay in the office, it's likely that because he's a businessman. So it's very likely that he will come to some sort of a deal after the election goes through. But again, we don't think that China and US will go back to the very honeymoon period before the Sino-American relationship starts to get sour in these few years. So there will be challenges, there will be news flow, but maybe will be hopefully a little bit better than what we see in these few months before the election. In case the opposing party come into office, hard to say. I've read different statements, but we'll just have to wait and see. Yeah.
Thank you. Also, there is a quick question from my side, I guess, towards both of the speakers. I want to know that how's the COVID-19 impact on your business? I mean, if you rank from like say positive to neutral to negative or slight negative, what's the real impact so far? For the first half of 2020. Sam, would you like to start first?
Well, I mean, we were about to raise a second fund for our debt business, and without traveling, we cannot raise the money. And I was stuck in New York in February because we're supposed to see a client in the Middle East, and with anchor investors. And then they say, well, don't come back to Asia. If you go back to Asia, you cannot come to the Middle East. So I had to stay in, I was stuck in New York. And then the whole outbreak comes, and then no one can travel anymore. But in terms of the portfolio-wise, I think the most hit is basically the China office. But the rest of the market, I think is quite stable. We made a huge exit in Korea, which is one of the market that had not been affected at all, which is amazing. And we made a huge exit in Korea, and we're about to make another exit in Korea in the next 2 months. For Japan, we have these budget hotels, portfolio in Japan, and we're doing very, very well, at plus 90+ occupancy rates. At the lowest point, it was down to 20%. Now it's back to 60%. So the hospitality sectors has been affected. But at the same time, we love the sector. We're looking for opportunity to buy. If there's some distress coming up, we're making bids. For Australia, we've been extremely busy doing a lot of debt deals. Where the local banks are being very cautious, and the APRA, which is the monetary authorities of similar in Australia, is like cramming down on lending for the big four. This gave us a lot of opportunities to do secure lendings. For Hong Kong, we are looking for distress, but not much. But for us, as I mentioned earlier, we are doing a lot of site assemblage. We're site assemble all the buildings. We did the strategy worked the best during soft markets.
So
Thank you. And Renee?
So for value partners, in terms of business operations, our offices are mostly in Hong Kong and Shanghai. We do have offices in like Singapore, a small office in Malaysia, and also UK. So I think for the overseas office, the interruptions of more people working from home. But for Hong Kong office, we have been always mostly work in the office with Team A and Team B. In terms of the stock market, I think, again, because you asked me the question now, the stock market has been so strong. So we are okay in terms of the portfolio. Some of our portfolio even appreciated 10% year to date because we have a lot of exposure in Asia market. But again, that definitely on the sales and marketing front, the business activities are much more affected and slowed down. For us, when we do due diligence, we see that Zoom calls or maybe conference call can still help maybe make up like 80% of the normal effectiveness. So that's the situation. Yeah.
Well, that's very encouraging to hear that both of the business are still growing very well. And because of the time constraint, we will pick up 2 more questions and we will wrap up the session. The next question is a little challenging. So we will see the tail risk between the US and the China relationship. What is the worst case scenario from your investment forecasting that you would like to see, you can consider when we build up this worst case scenario cases when you analyze the investment cases? Will US cut off SWIFT from your perspective? Maybe Renee, would you like to address it first?
Okay, sure. Yeah. So I think for the worst case scenario, I mean, there is this very small chance, but definitely one worst case would be is US and China into a very big war. That would be very detrimental to both economy or maybe the global economies. So, but I think a lot of the people at the end of the day, social stability or maybe people's living is very important in nowadays government's world. And they need especially in the Western countries, they need the voters to support them. If they don't have enough to eat, maybe they will just go opposite or not to support the government anymore. So this is a very small, I don't think it would be the final outcome, but if you ask me the worst case, that would be the worst case.
Okay. And Sam, what's your view?
I think we are seeing decoupling from US and China, right? There's no doubt about that. And how decoupling is remain to be seen. And right now, it's that the Asia market is big now. As I mentioned earlier, the Asia economy is 40% bigger than the US, while 10 years ago, it was at par. What the big risk in mind right now is that the elections, obviously, there's a lot of uncertainties. The polls saying that the Trump is losing, and that is, as you know, Trump is a fighter. I think he would do any tricks to win these elections. What I'm afraid that if he loses really behind, he starts some war, and that is going to be a huge negative impact on the market. That's another black swan event. Can you imagine that, right? But these are the worst case scenario. But for immediately, we think that the Asian market, it will recover first, and the Asian domestic spending market is getting big, and China is boosting the domestic consumption in China, and that's going to lead to Asian recovery much faster than the US and Europe.
Thank you. The last question is for Sam. What do you expect will be the implications for property markets in Asia from the slowdown in globalization, particularly as US and European firms repatriate supply chains?
Well, it's very difficult to repatriate the whole supply chain. You can maybe have one part up, and then the whole supply chain is in the whole area, is let's say in Shenzhen or in somewhere in China. It's going to be very difficult. I think right now you're seeing a lot of industries that leaving, which is more lower tech industries that is going to places like Vietnam, and elsewhere in Asia. But at the same time, the China is boosting the higher value manufacturing. For us, our portfolio, for Phoenix, we've been trimming down Asia, Greater China market exposure for the past 2 years. We've been increasing exposure, not because we're not seeing great opportunity in Greater China, but at the same time, we're seeing better opportunities in places like, Japan, Korea, Australia. And the reason is that, it's not, because that they have the highest, in terms of cash on cash yield. They have higher yield in terms of rentals and low interest rate. So that's why, what we're seeing is that the institutional investors are looking for yield right now, because that the interest rate is so low, you cannot get any yield from the bond market. So they are making shift from the fixed income into to real assets. So every real asset they're looking for yield. Right now we are not seeing that much growth in Greater China, so that's why the rental growth will not be going to be carrying the yield. So whether it be defensive like places like Japan, Korea, where you have a higher yield and lower interest rate, and people are looking for a high cash on cash yields. So like that what we're looking at in China is now is probably like, as I mentioned earlier, data center which have higher yield, but you'd have to take development risk and approval risk, because the government, getting data center is getting a license is very critical, getting power is very critical. Like for logistics, first tier city is no problem. The second, third is a lot of supply, and the supplies in China you cannot predict that this is the real supply, because sometimes they can convert some of these older, industrials, and just change it to logistics, and there's not recorded as a supply. But the first tier cities really lack supply.
Okay, thank you very much, Sam. This concludes our sharing today. Again, on behalf of the club, I would like to say thank you to both of speakers, Samuel and Renee, for your great sharing.
Thank you.
Also thanks for all attendees joining today. Bye-bye. Have a good weekend.
Okay,
Bye-bye.
thank you.
Thank you.
Thank you, Renee. Bye-bye. Thank you.
Bye. Thank you.
Okay, bye. Thank
Bye.
you all.
Bye. Thank you.
Thank you.